For decades, the United States stood as the undisputed leader in global corn exports. Its vast agricultural heartland and established trade relationships made it the default supplier for nations around the world. However, a significant change has begun to reshape this landscape. A fundamental recalibration of the global corn market is underway. Recent data reveals a subtle yet persistent decline in U.S. corn shipments to several key international buyers. It is a structural shift. Simultaneously, Canada is emerging as a formidable competitor in the corn export arena. The Canadian agricultural sector is demonstrating an agility that has caught many observers by surprise. It signals a potential realignment in the geopolitics of food. Welcome to Geo Capitalist channel, where we decode global wealth one power shift at a time. Today we spotlight a quiet revolution in global agriculture, why global buyers are ditching U.S. corn for Canada. If you value breakdowns like this, subscribe to the channel and let's dive in. This is the story of how a quiet power shift is creating billion-dollar consequences. The core of this agricultural trade shift lies in the changing calculations of global buyers. Nations in Asia and the Middle East depend on a steady flow of feed grains to sustain their economies. For these importers, supply chain predictability is a matter of national security and economic stability. Any disruption introduces a level of risk that they are increasingly unwilling to accept. Policy debates have created an atmosphere of uncertainty. This has led many to begin a quiet but deliberate process of diversification. This is where Canada has expertly positioned itself as the stable alternative. They have focused on modernizing their infrastructure and fostering trade-friendly policies. This provides a stark contrast to the friction points that have emerged elsewhere. Instead, it is winning on the basis of reliability. Canadian exporters are offering something incredibly valuable in today's fragile global economy: consistency. In a world of shifting alliances, this commitment to being a predictable supplier is a powerful advantage. Trade data from 2023 to 2025 reveals a troubling pattern for U.S. corn exports. Market share is diminishing in key regions. Shipments to China have significantly declined. Similar patterns are emerging in the Middle East and North Africa. This decline correlates with increasing uncertainty in U.S. trade policy. Buyers are being rerouted to more predictable suppliers. The issue isn't U.S. production, but the export ecosystem. A growing risk premium is being attached to U.S. commodities. Forecasts suggest this trend will continue, making lost market share difficult to reclaim. This marks a potential long-term realignment of the global corn market. The decline in U.S. corn exports between 2023 and 2025 cannot be fully understood without examining the political context. The legacy of Trump-era tariffs and the unpredictability of U.S. trade policy have cast a long shadow over agricultural commerce. Global buyers view trade through a geopolitical lens, interpreting policy shifts as signals of political instability. This has driven them to seek suppliers within more stable political frameworks, a strategy often referred to as de-risking. Increased administrative delays and complex export permits have contributed to the decline. This administrative unpredictability has made buyers wary of relying on American suppliers. This has prompted nations to diversify their sources, ensuring they are not vulnerable to policy changes. Global buyers are purchasing certainty, and the decline in U.S. exports is a consequence of hedging against American volatility. The export decline directly impacts American corn producers and their communities. For farmers, the export market is vital. Reduced orders create a domestic surplus, pressuring prices and impacting revenue across states like Iowa, Illinois, and Nebraska. This creates a challenging economic environment. Farmers face lower crop prices with rising costs. This threatens family farms and slows investment. Some producers consider crop rotations or alternative markets. The uncertainty creates instability, complicating future planning. The erosion of U.S. dominance is a kitchen table issue for American farming families. While the United States agricultural trade landscape experienced fluctuations, Canada cultivated an environment of stability. The Canadian government has long pursued a consistent, trade-oriented agricultural policy, deliberately avoiding the sudden tariffs that create uncertainty for global buyers. Ottawa understands that for commodity importers, policy predictability is paramount. Canada has successfully positioned itself as a reliable, low-risk partner in a volatile global market. This foundation of stable policy has been instrumental in attracting buyers who are actively de-risking their supply chains. Unlike the shifting political winds that have impacted United States trade, Canada's multi-party consensus provides a long-term guarantee of continuity. In essence, Canada is selling the assurance of uninterrupted supply, a product that has become increasingly valuable. As a nation with a smaller domestic market, its agricultural sector is fundamentally dependent on exports for growth and prosperity. Ultimately, Canada's strategic move into the corn market was enabled first and foremost by its unwavering policy posture, turning its consistency into a powerful tool for capturing market share and building lasting trade relationships. Canada's agricultural sector seized a unique opportunity by modernizing its entire grain export system. Major grain companies like Richardson International and Viterra invested heavily in expanding storage and upgrading rail networks, especially in Manitoba and Ontario. Enhanced coordination with Canadian National and Canadian Pacific Railways slashed transit times, ensuring grain moves swiftly from farm to port. Ports in Thunder Bay and Vancouver received state-of-the-art upgrades, faster loading, deeper berths, and advanced quality controls. These improvements mean buyers in Asia can now count on faster, more reliable shipments from Canada. The result: Canada can export more corn more efficiently and with fewer delays, reinforcing its reputation as a dependable supplier. This modernization wasn't just a reaction to short-term market shifts. It was a long-term vision to build a resilient, competitive export platform. By investing in capacity and efficiency, Canada positioned itself as a serious contender in the global corn market. The new system is purpose-built for a risk-averse world, giving Canada a decisive edge. Canada's grain export infrastructure is now among the most modern and reliable in the world. Canada's agricultural strategy is unapologetically export-focused. Unlike the U.S., where most corn is used domestically, Canada's model is built to serve global markets. Research and policy are geared toward developing crop varieties with traits demanded by international buyers. Grain companies work closely with farmers, aligning production with global trends and specific buyer needs. This creates a responsive supply chain that adapts quickly to changing demands. Canadian trade missions and marketing agencies are constantly building relationships and opening new markets worldwide. The result is a steady, reliable presence in global trade, contrasting with the volatility seen elsewhere. Canada competes on strategy, agility, and customer focus, not just scale. By prioritizing global buyers, Canada has turned export dependency into a strength. This export-first mindset is the engine behind Canada's growing share of the global corn market. Canada's coastal and inland ports are the backbone of its corn export power. The Port of Vancouver offers direct, faster routes to Asia, reducing shipping costs and spoilage risk. Thunder Bay connects Western Canada to the Atlantic, serving Europe, the Middle East, and North Africa. Both ports feature advanced terminals capable of rapid, high-volume grain handling. Upgraded rail links ensure seamless movement from inland elevators to ships. Coordination between port authorities, terminal operators, and railways minimizes delays and maximizes efficiency. Streamlined customs and inspection processes at Canadian ports enhance reliability. Buyers know shipments from Vancouver or Thunder Bay are less likely to face unexpected delays. In commodity trading, this predictability is a major advantage. Canada's ports are not just infrastructure. They're a core part of its competitive edge in the global corn market. Their efficiency and reliability have become magnets for global buyers. Canada's ports transform logistical strength into market power. Richardson International and Viterra are the corporate engines driving Canada's grain export success. Richardson operates a vast network of modernized grain facilities and export terminals in Vancouver and Thunder Bay. Viterra, part of a global network, channels grain efficiently from key regions to export markets. Both companies control quality and logistics from farm to vessel, offering buyers certainty and consistency. Their involvement goes beyond trading. They provide farmers with advice, financing, and crop inputs, ensuring a steady supply of export-quality corn. By contracting directly with producers, they secure reliable pipelines for large, long-term international contracts. Their aggressive investments in logistics and infrastructure were timed to capture new demand as buyers sought alternatives to the U.S. These companies have made Canada a formidable competitor in the global feed grain trade. Their logistical excellence is a key tool in Canada's market capture. Canada's strength lies in its seamless logistics from farm to freight. The process starts at local grain elevators, where corn is graded, cleaned, and loaded onto unit trains. Canadian National and Canadian Pacific Kansas City Railways form the backbone, moving grain efficiently to ports. Billions invested in new hopper cars, longer sidings, and tracking tech enable precise real-time coordination. Grain companies, railways, and ports collaborate closely, sharing data to keep the supply chain fluid. When a major order comes in, the entire system mobilizes, allocating grain, scheduling trains, and prepping port facilities. This integration delivers reliability and predictability for international buyers. Importers aren't just buying corn, they're buying access to a world-class logistics system. Canada's farm-to-freight network is its hidden weapon in the global corn market. Quiet efficiency is what sets Canada apart. China and Middle Eastern nations are reshaping the global corn market with deliberate procurement strategies. For them, corn imports are about food security and economic stability, not just price. China is systematically diversifying away from U.S. suppliers to reduce risk and avoid political friction. Middle Eastern buyers facing limited domestic production are also seeking more stable partners. Recent U.S. export delays and unpredictability have pushed these nations to look north. State-backed agencies are rewriting contracts to include larger Canadian volumes. This isn't about price or quality, it's about mitigating political and logistical risk. By building strong trade links with Canada, these buyers are hedging against global uncertainty. Data from 2023-2025 shows a clear rise in Canadian corn shipments to China and the Persian Gulf as U.S. volumes decline. This is a conscious, top-down policy shift by major buyers. Canada's stable policies and efficient logistics have made it the primary beneficiary. The global agricultural trade map is being redrawn, and Canada is at the center. global buyers are now prioritizing risk hedging in their procurement strategies. Supplier reliability has become a key variable. Importers are assessing political and logistical risks alongside cost. This favors nations offering consistency, leading to diversified sourcing. Canada benefits as a stable alternative, reducing reliance on dominant markets. Buyers are willing to pay a premium for low-risk suppliers like Canada. This shift reflects a need for food security in an unpredictable world, where supply chain resilience is paramount. The divergence in the corn export market between the United States and Canada can be traced directly to their contrasting national policy philosophies. In recent years, U.S. policy has been characterized by a more inward-looking focus, emphasizing themes of reshoring, trade rebalancing, and national food security. This has led to the implementation of tariffs, the use of trade negotiations as a tool for broader political leverage, and a more complex regulatory environment for exporters. While intended to protect domestic interests, this approach has projected an image of unpredictability to global partners. The perception among international buyers is that U.S. trade rules can be subject to abrupt changes, making long-term supply contracts feel inherently riskier. In stark contrast, Canada has deliberately pursued a policy of aggressive trade internationalism. Its agricultural strategy is built on the foundational belief that national prosperity is directly linked to its ability to export goods reliably. Canadian policy is designed to foster stability, minimize trade friction, and actively court international buyers. The government has focused on signing free trade agreements, streamlining export processes, and investing in infrastructure to make Canadian products the easiest and most reliable to procure. This outward-facing approach provides a stable alternative for buyers seeking to escape volatility. This policy contrast is most evident in how each nation approaches its agricultural surplus. The U.S. has a massive domestic market for its corn, including a significant ethanol industry, so its export strategy can appear secondary to domestic priorities. For Canada, with its smaller population, exports are not a secondary outlet. They are the primary engine of the agricultural economy. This fundamental difference in perspective shapes every decision. Canadian policymakers are constantly asking how they can better serve their international customers. As a result, the two nations send very different signals. The United States projects power and domestic prioritization, which can be interpreted as potential volatility. Canada projects consistency and a commitment to being a dependable global supplier. For a purchasing manager in Beijing or Riyadh, the Canadian message of quiet, unwavering reliability has become increasingly appealing. This policy divergence has created a clear competitive opening, which Canada has skillfully exploited in the global agricultural marketplace. The shift in the corn market highlights a new dynamic in global trade, pitting the U.S.'s immense scale against Canada's strategic agility. The U.S. remains an agricultural superpower, but scale alone is no longer the sole determinant of market leadership. Canada has built its competitive advantage around agility and responsiveness. This has allowed Canada to win market share by outmaneuvering the U.S. in service and reliability. A U.S. contract offers access to the world's largest corn market, but may come with policy risks. A Canadian contract offers a reliable, customer-focused system. This new landscape suggests that global influence in food exports is changing. Market share can be won through other means. Being the most reliable partner can be just as important as being the biggest. The shift in the global corn market illustrates the new geopolitics of food. The bigger picture reveals a world where the instruments of influence are changing. No longer is sheer production scale the only measure of power, but policy stability and logistical agility. Canada's rise is a quiet absorption of market share, earned by providing certainty. Nations are hedging their bets, building resilient supply chains, and prioritizing predictability. Canada cannot replace the U.S. as the world's corn supplier. It has positioned itself as the indispensable alternative, allowing buyers to diversify their risk. Strategic positioning can be as potent as raw capacity. Internal policies have direct consequences on global competitiveness. Trust is the ultimate foundation of trade. Quiet reliability is becoming a superpower. Food exports have always been a tool of global influence, but the nature of that influence is changing. It is about who can be trusted the most. Canada is building a reputation as a trusted supplier for a fragile world.